Hey traders, it's James here from the A1 content team, and as we start today's stream, I want to share with you some exciting news from our friends over at FX2 Funding. FX2 has just launched their two-stage evaluation. The two-stage differs significantly from their one-stage, offering many benefits to traders. First of all, the profit targets are much more manageable, with 8% in the first stage and 5% in the second stage. Next, you'll get a 10% fixed overall drawdown that does not trail your account balance. You get all these perks on top of FX2's existing world-class customer service, high-performance technology, and a choice between two amazing trading platforms, C-Trader and DXTrade. There's a reason FX2 Funding boasts a Trustpilot rating of 4.7 in this time of industry turmoil. They are a serious company run by seasoned business professionals and always take conservative steps to protect their traders. For traders looking to get funded, you can use promo code A1Trading15 to save 15% on all funded accounts. That's A1Trading15. The promo code can be found in the link in the description below and in the live stream chat right now. Now, on to the show.
All right. Good morning, guys. Welcome back to another live stream. Hope you're doing well. I got to play my intro music. Here we go. Boom. Intro music is playing. Hope everyone's doing well. Happy Monday to you. You know, they say that nobody loves a Monday more than traders because the market is back open and us degenerates can get back to work. Just kidding, but good to see everybody here. We got 150 people watching as the stream gets started here today. The dollar index continues to push up, but at the same time, gold is bouncing a little bit and stocks are down. That to me sounds like good old-fashioned risk off, but the only thing that's not playing ball is the yields world. Yields are still up, so let's pull up yields for a second. Take a look at the 2-year yield. Well, 2-year yield's coming down just a little bit. 10-year is up. 20-year is up. The yields on them, of course. I am long gold, slightly in the red on this initial position, but I had a little bit of a hiccup on my trade that I need to talk about. So long story short, I accidentally closed my first position and re-entered at like within a minute. So my P&L looks a lot better on the second trade, but this is initially when I got long gold. So I went long gold here, but then I accidentally closed out of my position early. I was clicking through my platform and I have my on my Webull or whatever, my trigger is very light on closing and entering trades, which maybe I should tighten up. But anyways, I closed out of the position, then re-entered it. So same trade. I realized a loss and then entered it back right away. But I am in gold, and on my initial attempt, I'm still slightly in the red. So this is where, transparently, where I got long gold, but then I accidentally closed and reopened the position. So I just wanted to get that out of the way. If I pull up gold and you see the entries look a little bit different, that is what happened. I'm also short on oil. This one I did not goof up on. I'm still short on this one, USO. And oil is up slightly on the day. Well, it's up, 0.75%. So oil is up. Commodities as a whole seem to be up today. You've got the dollar index again, as I mentioned. You know what? I want to start fresh on this chart. I've got some zones that have been here for an entire generation. So it's probably time that we switch it up. What's it going to look like? Let's get the mystery box out. Hey, Dre, what's up, man? I caught EU at 1.08929 this morning. Dre, thank you very much for the $2, man. I appreciate that. Making it rain here. Let's see what we can get. Get some sound effects for Dre.
You what?
Thank you so much for the donation. I appreciate that. So I got to speak candidly here. Even though I've been bearish on the dollar, this looks like a little bit of a short-term breakout. So let me get some zones going here. So, caught EU at 1.089. Dre, I'm imagining you're probably short on euro dollar. So let's talk about this. So we have a little bit of a breakout forming on the dollar index. We have some key resistance up here. We have some what was key resistance right here that actually broke out. The dollar index trading higher on the same day that gold is trading higher is something to pay attention to, okay? You always have to wonder, what is that all about when both are moving up at the same time or both are moving down at the same time? It's worth mentioning. Also, if you're just tuning in to the stream, thank you for joining me here. We are live today. And you know what? Why don't we check the stream schedule? I got to do it myself. Pull up the stream schedule on the EDGEFINDER or on our website, a1trading.com. You can always keep up to date with what the shows are going to look like. Today, our lineup is looking like, you got me, Ivan, Chris, Frank. My goodness, we got a very busy stream today, to say the least. So, going to be fun. Today is kind of a light start to the week, but really I want to draw you guys' attention to this little old block right here. Wednesday and Thursday are really big days. You've got the Fed meeting, you've got CPI, you've got the producer price index on Thursday. And just to close out the week, we have consumer sentiment, which is important as well. So stay tuned. Should be a very, very busy week. We'll be live streaming for, again, most of it. Still bullish on gold here. Gold holding on to its bullish reading. I am still also long TLT. The 10-year treasury bonds looking relatively attractive with some slowdown in the economy. Recently, again, we've had manufacturing PMIs missed, GDP numbers missed. Services were a little strong, so that works against our idea there. But retail sales missed. Inflation, we'll get some latest readings of that this week. And then jobs last week were good, but they were mixed. So again, something to point out there. Also, I need to check something. I think something is messed up with the unemployment rate tracker here. And if it is, yeah, we should have a 4%. I'm going to write this down, guys, really quick. Unemployment rate error. Bear with me. Sometimes when I see something that's off on the EDGEFINDER, I have to write it down on the stream so that I can send it over to the devs after the stream. U.S. oil still bearish on this one. We've got platinum, Aussie Swiss, CAD Swiss, dollar Swiss, a lot of Swiss pairs. You know, the EDGEFINDER is kind of pointing out the Swiss franc looking strong, right? So selling other things against the Swiss franc. I actually like that setup on the dollar. If you do get a little bit more upside on the dollar index, this level looks really interesting. For sell side on dollar Swiss, I like that one personally. And let's pull up the euro here. Again, Dre mentioned that he's short on the euro as of 1.0892, 1.0889. Wow, so you're up here. Very nice, Dre. Shout out to Dre. Again, thank you for the donation, man. I appreciate it. Yeah, euro looking like it really has changed its tone here, right? You had this really nice upward trend forming, then the big breakout here on Friday and the follow through today. So I'd say if you I mean, as it stands, it already looks like it's kind of broken structure. You do have a little bit of support that it's coming into today. If you break through that level, then suddenly things look a little wobbly for the euro. Dollar is looking, like I said, it's looking pretty strong. Hard to deny what we've seen on the daily chart recently, a little bit of a breakout here. I'd watch how this candle closes today, guys, because if you get a candle close with a long wick on top, if you get a candle that looks like this today, that could suggest like this is just a little bit of a pullback move. But if you get a strong bodied candle closing like this today, like if it closes how it looks right now, that could indicate that perhaps there's a little bit more upside here. But again, I think it comes down to what we get out of CPI and FOMC on Wednesday. So be very careful with this. I wouldn't read too much into the price action ahead of these news events. Yes, there might be some trades ahead of time, but just be aware that those news events will take precedence. The fundamentals there are just really, really important this week. The S&P 500 is, you can't even call this a pullback, but nowadays this is like the most pullback you ever see before it just rips higher again. I'm kidding, but right now the stock market is in just a super strong trend to the upside. I have sold calls against my VOO and XLK positions. I've talked about that a lot. So I'm kind of like very cautiously bearish on the market. I'm not shorting it, and I actually don't make a ton of money if the market sells off. I just cushion my position because I've sold calls. So I've sold the, well, let me check. What calls did I sell? Let me just pull this up. I sold calls on my VOO, the 490 calls and the 220 calls on XLK 1 month out. So we'll see how that one plays out. But 5th of July, so we're about 5 days into these calls that I've sold. Market is just about to open up, so we'll see what those calls are looking like today. But again, I sold my VOO calls at 490, so really like right where it's at. So basically, if the market rips higher in the next month, I will not benefit from that upside. But if the market goes down in the next month or pulls back, then I actually will be in a position of kind of a hedged position. So you could kind of argue that my position is more bearish than it is bullish, but I still hold shares long. So my money is still parked long on the, on VOO and XLK and that sort of thing, but I've sold calls against my position. So short term, I do think that the indices have room to pull back. I know Frank also is kind of in that camp. Some of the economic data is coming in light, and again, I think with unemployment on the rise recently, I think that you have PMIs slowing in the manufacturing. You have a couple figures there that just don't look super attractive for the indices, in my view. Again, the slowdown factor keeps me a little bit more oriented towards these three setups. I'm short oil, I'm long gold, I'm long bonds. So that's where I'm at with it. The VIX is up today. VIX being up today makes sense because, again, you have CPI and the Fed meeting this week. So volatility is kind of expected. So the VIX is going to jump on that. The Russell is down 1% on the day. I mean, this is, man, if you're somebody who watches the Russell, does anybody here trade the Russell? Let me know if you trade the Russell. Type yes in the chat if you ever trade the Russell, whether it be through options like IWM, or if you ever pay attention to the Russell at all, just type yes in the chat. I'm just curious. Super laggy? Are we lagging? Is anybody lagging? But yeah, so look at the Russell. I mean, the Russell's down another 1% today. This market is not, it is not a fair, not all markets are treated equal. Okay, because look at this, down 1% to start Monday. I mean, 1%. The Russell is smaller cap companies in the US, and I've given this speech 100 times, but bear with me. Small caps have done nothing in years. Smaller companies are still taking it on the jaw, right? From higher interest rates and an economy that is holding it together. But I make this point too. Why focus on the Russell? Why focus on the Russell? Because if you get the holy grail set up for the Russell, the returns are bomb. They're massive. Okay. So check this out. If you get good growth and interest rates that are accommodating or low, right? The Russell will fly. Like, if that environment sets up, in my view, I want to be long the Russell. I want to be holding on tight to Russell positions. In fact, that's a scenario where I almost would touch some calls. Like I'd get long calls if this perfect scenario sets up. Why? Because look what happened in 2020. In 2020, the Russell exploded. It doubled. It went up 150% because the Fed was accommodating and growth was holding in there, right? Fed was printing money like crazy. My point was showing you that is that when you get the perfect scenario of, an expanding economy and accommodative Fed, that's when I want to be long the Russell. But is that today? Is that right now? No. And I think if you're patient, you'll get your chance with the Russell. And that's my opinion on it. I want to touch the Russell myself. I want to be long the Russell, but not until the clouds roll away. Again, the bane of the pro and con of the Russell is that if you get a Goldilocks clouds roll away scenario, you want to be long long the Russell. But if you don't get that, you want to stay far away because this thing just, again, has done nothing in several years. So look at US 30. Yeah. Oh, let me share my screen again. Get some lag on the screen. Sorry about that, guys. Try this out. See if this looks a little bit better. Let me know. Let me know if the screen looks okay. So what about the Dow, the US 30? Well, the US 30 has also not done as well recently as like the NASDAQ, because this is a more kind of slow, choppy. By the way, guys, let me know if the screen looks a little bit better, if we're lagging or not. The Dow Jones has not done nearly as well because it's not so concentrated in semiconductors. Semiconductors are the whole thing. Still the same? Hold on, guys. Let me play with it. Stop sharing the screen. Maybe if I try not sharing audio, we'll fix it. Is the screen blurry or just delayed? All good now. Okay, cool. I wonder what I closed. I closed my Webull. Maybe my Webull was dragging my computer down or something. I don't know. Sorry about that. Anyways, the Dow Jones doesn't have, you have to think, if you're trading an index, the index has stuff in it. What is in the index? That's what the question is. For the S&P 500, you get a little bit of everything. For the NASDAQ, you get a lot of tech. For the Dow Jones, you get a lot of stable, big companies like McDonald's or United Healthcare, right? So yeah, with the Dow Jones, you have not seen the same massive, run up. You've still seen a great recovery, but not seen the same massive, run up that the NASDAQ has, because again, the NASDAQ is running high on tech, which is exploding in the last few years. But it wasn't exploding in 2022. Just remember that just because something is working right now does not mean that it's a guarantee to just keep running the same way. Like the NASDAQ very quickly could have a 20% pullback again. People forget this until it happens. And then like, oh my gosh, trading indices is not as easy as wake up and buy. It's just that when it's working, it seems so easy. And then it no longer works anymore and you get taught a lesson. What's up, Web Trades? Would love to get your opinion on buying the 10-year T-note. It's a buy in the EDGEFINDER. Yeah, I have long TLT. I'm long TLT currently. It's I'm in the red on it, but I like the idea of buying bonds. The 10-year is TLT is like the 20-year, which is not the exact same, but they generally are going to move in the same direction. The reasoning, the logic behind why having a little position in bonds. Well, for me, the thought process is economic data coming in a little bit light makes me a little thinking that, okay, rate cuts are probably coming. And when the market starts to see rate cuts coming, a lot of times that's because the economy itself is starting to slow down. So you can see the contributing factors to this bullish reading are GDP numbers, manufacturing PMIs have come in light. Remember that if this is positive, that's reading as, oh, the economic data is light for this asset. Now, it's not the same for everything else. Oil, for example, does not benefit from weakening economic data. It actually it's less attractive. So remember that the same data coming in it's not treated equally to every asset. But for bonds, the way we've scored the system is that when you have GDP numbers coming in lighter than expected, I'll show you that now, right? our algorithm says, oh, look, GDP numbers are coming in lighter than expected. We forecasted for 1.6, we got 1.3. So economic data is coming in light. So what do we do with that? Well, we say, well, if GDP numbers are light, that's going to suggest that they may cut rates. And if they cut rates, you want to buy bonds before they cut rates because the bond will be more attractive when rates are coming down, right? That's the idea. At least that's my opinion, my take on this. So GDP, manufacturing PMI is missed. Services PMI came out better than expected, so that works against our idea. Retail sales came in lighter than expected. Inflation overall seems to be coming down, at least according to relative to forecasts. It's hitting forecasts, or at least coming down a little bit. And then jobs data was really strong. That's not great, but unemployment rate ticked up. The percentage went from 3.9 to 4. So this is how the system is generating these bullish or bearish readings. By the way, if you would like to try out the Edge Finder, we've already got it dropped in the chat here for you. Click this link if you are not already using the Edge Finder and you'd like to try it for 30 days. Again, 30 days, you can get access set up right there. Click that, fill out that quick little application. And you get some information sent to you about how you can get 30 days access set up to the Edge Finder to try it out to see if it's right for you. If you're trying to use fundamentals, again, fundamentals are just too much to do in your head. I used to do it by hand and by paper, and it would take me so much time. So automating that process using software is game changer because you can look at all the different economic data points. By the way, if you want to look at the data points themselves, let's say I'm looking at gold. If I want to look at, well, what was the GDP forecast? Well, it was forecasted for 1.6. We got 1.3. That lighter than anticipated print is good or blue for gold, right? So you can head over to the data scanners page. I'd highly recommend that if you have the Edge Finder, head over to these pages, get familiar with them. It's a great way to just read through the data yourself and make sure you're mentally understanding, like, what trends are we picking up on? What is the data points that are being contributed to this scoring? Also, if you are an Edge Finder user, you can always click help right here. If you have a copy, click help, and you can set up a call with one of our team members. You can ask a technical question to one of our devs, or you can actually go through our tutorials on our website as well. All of this is linked here on this page directly. And also, one other thing is that if you are an existing Edge Finder user and you have some feedback for us, please always feel free to leave us that feedback. It is very helpful. So again, if you'd like to try it, we'll drop it one more time in the chat if you don't mind, James. So there is the link. If you guys wouldn't mind taking a second to fill out that application, you get 30 days access to our tool to see if it's right for you. Let's take a look at gold. Yeah, so I am long gold already. I may have been too early. We'll see. My stop loss is below these lows. If price breaks through this low, I'm out. I take a loss. If the market rallies, then I'll look to trail stops. I think we have more upside than downside. Again, based on all that cooling economic data, I still like the story for gold, even though the big headline news was, oh, well, China's not buying as much of it anymore. The Central Bank of China was buying aggressively gold in recent months. So a slowdown in that is a little bit of a cause concern, but I think that I think there might have been a little bit of an overreaction. I still think the story for being long gold looks pretty good. US debt is, skyrocketing higher at the same time. The economy is showing signs of slowing down. And so I like the story for gold longs. I'll still stay long. I'll be looking for opportunities. If we break this though, then I'm wrong about my idea for now. And my next entry probably wouldn't be down until this area, or unless, we do something like this where we start forming higher lows again. But stop loss is in place for a reason. If I'm wrong about this, I'll stop out here. I'm also short oil, as I mentioned earlier. I have a position on this one. I'm long TLT. Stocks, S&P 500. I am interested in this if it pulls back for a while, but at these levels, I think that it's a bit overextended. I think it's probably due for a pullback. Again, with that, a lot of people are cheering the idea that, well, the economy is starting to show signs of cooling. The jobs market is slowing down. That's going to get the Fed to rate cut. And the idea is that will lead to another leg higher in the stock market. And that may be the case. But the old kind of expression with rates, interest rates with the stock market is you want to buy the rumor, sell the news with interest rates. I mean, you do what you want, but that's the old kind of mentality of Wall Street is, you know, the time that they actually start cutting rates, by the time they actually start cutting rates is because the economy is meaningfully slowing. And being long stocks into a potential recession or a moderating economy for a while is something to think about carefully, because you might be in the stock market at a point when earnings for companies are slowing down, right? Because remember, if the economy is slowing down, earnings will likely follow the economy in that. So just be careful with that. I think that for me, I still like the idea of being long stocks. I think there is a possibility that you do see kind of that soft landing overall, but doesn't mean there won't be some choppiness along the way. You may see some corrections, you may see some pullbacks. And I've mentioned many times that I am, a little bit hesitant with the stock market simply because it is being propped up, namely by like Nvidia. Like Nvidia is just rocketing higher. Sure, you do also have names like Microsoft, and these are companies that are doing remarkably well, but I just think, you have to be careful when something like Nvidia is just carrying the whole stock market. These things can go down. There was a point where this looked like, Frank and I talked about this on Friday, where Tesla looked like this. And some of you guys might even remember there was a while where Tesla looked like it was pulling the whole market higher. It was rising in the ranks of the S&P 500 very rapidly. And then it really lost its crown. And my point with sharing that is that at some point Nvidia may experience something similar. Will it be as drastic of a drawdown? Maybe, maybe not. I don't own any Nvidia shares. Would I like to own some? Yes, I would, but I'll probably wait for pullbacks, because the greatest stocks, the greatest companies, the greatest, no bull market is forever. No. So am I missing out on Nvidia? I am. And to the people who have Nvidia shares, more power to you, and congrats on your massive, massive win. But I think for me, as a sideliner to the Nvidia story, not entirely. I mean, I've been long tech for months. I mean, a lot of my gains have come from XLK, which also benefits greatly from Nvidia. So I wouldn't say I'm completely missing out. XLK has been a monster in my account for the last, 2022, I was really long like tech stocks, and this has done very well. But if you're teasing me, you could say, well, it ain't no Nvidia, right? Because here's SMH, the ETF for semiconductors, up 191%. But a profit is a profit. I've been profitable over the years, and to be honest, I'm not looking to change anything drastically. And one thing that would be a drastic change for me is chasing hype, chasing Nvidia. Is it a company that is amazing? Yes, it is. It's such a powerful winning company. But I have to be careful with this. So I'd love to be a buyer, but I'd love to be a buyer when it's right to buy. For me, you do what you want. But for me, that means wait for the market to get oversold on Nvidia. A simple indicator for me in terms of like a longer term positioning on Nvidia is wait patiently for an RSI of oversold. Maybe I go like, let's do this. Wait for a 7-day RSI oversold, right? A simple indicator that would have gotten you in right here, right? And the gains that you could have made, obviously in hindsight, are pretty crazy. But you don't get that reading very often. I mean, look at this. 2023 in October. Very rare, but a simple RSI filter would probably get me into a price that I'm happier with than just buying up here when it's, by definition, the RSI overbought, right? So I'm talking about Nvidia so much because, again, it is what's driving like the NASDAQ and the S&P, which are things that I trade myself. Talk about oil. Yeah. So I'm short oil. I shorted oil off the idea that economic data coming in light. I think rates could come down from that same reason. If rates do come down, you might actually see oil prices start to move higher at some point, because again, that could stimulate the economy. But my thought process on it is that I'm going to trade the trend that's in front of me. So let's say that this is the economy, E for economic data. If economic data is trending lower, and you might say, well, then they will do the rate cut. So then it's going to actually trend back up, right? Maybe, but maybe it doesn't. Maybe when they cut the rates, it's because the economy has already turned its ship, and it may go for a while before it turns. Again, the stock market, the market itself, oftentimes is wrong. We know this. If you look at 2020, 2022 was a massive popping of a lot of liquidity that came into the market from stimulus checks and free money from low interest rates. My point is this: on the first rate cut, when they do actually cut rates, many people are anticipating that this will happen, that you'll have the perfect, the economy starts to cool, rate cuts happen, and the market is back. And that, a sudden, huge increase in liquidity will bring the market back to a roaring economy again. And that could be the case. And I'm not saying that it can't be the case, but I want to be prepared for either way. So this scenario where the economy continues to deteriorate after rate cuts, that is gold city. That's where I want to be: long gold, long TLT, etc. And then in this case, no question, stocks. So this is kind of where we're at. We're approaching what I think is the rate cut moment, and we don't know what this post-rate cut environment will look like. I mean, first of all, we don't know when the rate cut's coming. That's still up for debate. This is a moving needle. This is why stocks and this is why markets are so hard. We don't know when the rate cut comes in. We also don't know what happens after the rate cuts. But for me, I'm going to follow this yellow line. Wherever the economic data goes, how will I track that? EDGEFINDER, come on. I'll follow the economic data and stay in line with what it's telling me. If the economic data starts to come in hot after rate cuts, I am back into stocks. I mean, I am in stocks right now. I'm keeping a position in both of these to kind of hedge my bets a little bit. But I'll be heavier in stocks if we get this environment, and I'll be heavier in these TLT, gold, etc. In the opposite scenario. Was that helpful? I don't know if that was helpful to you. If that was, do me a quick favor. Just type yes in the chat. Let me know that little breakdown about the rate cut environments ahead will be interesting to hear if you guys were helped by that. No Ivan today. Okay. Update on the stream today. No Ivan. But we still have do we have no Ivan today? We have Chris at, is this Chris at 10? Yeah, I'm going to guess that's Chris at 10. James, if you don't mind, when you add these, could you put the times in there too, just so I can check on that? So we got Chris at 10, I believe, and then Frank will join after that. NASDAQ down 0.2% today. Again, really not moving that much. I wouldn't expect, to be honest, the markets to move too much today. The real main events are going to be taking place right here. So just something to think about. You've got the producer price index, CPI, Fed meeting. I mean, it is a chaotic week. And we'll be here for all of it. Look at that. The Dow. Oh, this is interesting. Add some drama to the mix, guys. The Dow is up. Look at the price action between the Dow Jones and the NASDAQ. Look at this. 15-minute candles. NASDAQ down, Dow up. There is some divergence happening in the indices recently. It is because, I mean, it's actually been the opposite recently. You've had NASDAQ up, Dow down. Perhaps a little bit of a shift in the tide here. Let's take a look at gold on the 15-minute chart. Again, I am long gold, slightly in the red from my initial position. I'll stay in oil as long as we don't break this resistance. If we break that, we break the 618, I will take profits on that trade. Silver's up 1.2% here today. Gold up just shy of 0.5%. Will I see? I can actually see my, I'm going to try and open up my Webull again here today. Let's hope it doesn't lag the screen. Okay, so VOO calls, sold 4 contracts. My max profit on this for VOO calls that I sold is $2,400. On the day, I'm up 620, but overall, I am now flat. So I'm flat on the day. Similar story for XLK, which is a technology ETF. It's pretty much the NASDAQ. XLK technology up 360 today, still slightly in the red on this. So what are we saying here? So I'm long XLK, think the NASDAQ for a second. Just pretend this is NASDAQ. It moves very similar, high correlation. And VOO, this is the S&P 500. So I'm long these two things. But what I did last week, when I was actually still in Ireland, I sold calls against my existing position. I sold 10 contracts, which is 1,000 shares. I sold calls on XOK, and I sold 4 contracts, which represents 400 shares, 490 VOO. So all this is saying is I basically picked up a hedge. Now, the ideal scenario for that would be the market goes sideways or slightly down in the next month, and then I will make, between those two positions, I would make about, let's call it $4,200. I mean, I'll get paid $4,200 no matter what, which sounds too good to be true. But when you understand how covered calls work, I'm getting paid to cap my upside essentially and sell someone else the right to buy a bunch of shares of XLK or VOO at these prices. So I will make money as long as price is near or below 220 on XLK and 490 on VOO. So I have capped my upside. We will see where that goes. Again, I'm not bearish. That's what, if I was bearish, I would have shorted or sold my position completely. I'm just kind of in the camp of economic data looks a little bit light. Looks like we're going into some rocky territory in terms of, wage growth was strong. So inflation pressures may persist. And at the same time, we're seeing the story for economic data starting to lighten up. So that environment, again, not bearish stocks, but cautious. I've made really great money on these moves on XOK and VOO. And I don't think it's too much to say, I'm just going to cap my upside from here. If the market rips higher, then I don't enjoy those profits. I just collect the premium, the $4,000 in premium. But if the market rolls over, I make the $4,000 in premium still, but I also, would incur some losses on my underlying position for VOO and XOK. Anyways, guys, we're going to take just a quick break here to thank one of our sponsors, and then we're going to be joined by the one and only Chris Pulver just after this quick break. Stay tuned. We'll be right back.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we're back. Hey, Chris, how's it going, man?
What's happening, Nick?
It's been a minute. It's good to be back with you.
know.
And I was Chris, when I was gone, it was like it's so weird when you go from staring at the stuff every day and then you have like a time jump where you don't. And then you're like,
Yeah.
well, what has been going on? So I was just explaining, I think you heard a little bit of it, just where I'm at with the market. I've had some positions that have been going really well. My tech ETF and VOO and stuff like that are going really well. But I've chosen to cap my upside, thinking that we may see a bit of a pullback here.
Okay.
Or at least sideways, a little consolidation. I think that that's where I'm at with it. But what are your thoughts? Stocks ripping higher, unstoppable uptrend here. Nvidia is a monster. What are your thoughts?
Yeah, so I am getting positioned for some volatility, as you
Okay.
can expect. So I'm looking for. I think that there's way more downside potential than upside potential. I think if we go upside potential, that's the market ignoring a lot of stuff. And I think if we have downside potential, that's like the quick, aggressive, nasty cleanse that the market's probably fearful is likely. But I think that's the higher probability is that the Fed this week talks the market down a little bit. I was gone a week like you were last week, and I just spot checked. I mean, honestly, it was a pretty easy trading week. I actually hit new highs and watermark highs for all my accounts. Like, couldn't have asked for a better time to be away, to be in a terrible time zone to trade. I mean, you're in Ireland, right?
Yeah.
You're in
Where were you
Ireland.
again?
I was in Germany all week.
Germany, yes. That's tough times.
So I was like, I
time
mean,
zones.
at this time, I'm 6 hours ahead. I'm like, there's just no way I'm going to trade. So I mean, I was checking on things, and evening time is like middle of the day in the U.S. So I just followed along, but I didn't place a single trade. I didn't have to. All my trades that were expiring on Friday were full profit, so I just let them do their thing. But anyway, I think that I'll show my screen here just a little bit. I think I'm presenting or sharing on the other end. Yeah. So let me make sure this trade got filled, and I've got one more trade to fill here, similar in this account, and I'll tell you what I'm doing here. So 9072.
Of course, that dollar index too. I don't know if you saw that dollar index.
I did see that. That was
still playing some dollar crosses, right? Or you have a basket against a dollar or something?
Yeah. So I'm still mixed on the dollar. I mean, right now my positions that are doing well, my dollar CAD is cranking to the upside. Finally in two positions here. So I've got the dollar CAD. I bought in on this first pullback right around 36.50. And then I bought in around 3,600. So I've got two trades in, all running to the upside. I'm trying to get the dollar CAD back to 38.50 or higher. I think that that's possible to hit that level this week. Another one, I mean, right now we see that, oil has made a pretty good drop to the downside. So that should also favor, well, it did make a downside move, but oil's kind of ripping back here. This is another position where I don't want to trade it. I feel like the dollar index to me is a bit noisy. So I'm kind of trading both directions. But the oil play, it's like I still want to buy it low. I want to sell it high. I don't really like how this is very indecisive, unless if we see this happen, Nick, where we go up here, challenge this high, that might be oil's way of making bullish head and shoulders or something like that. Otherwise, sell resistance, buy support, stay out of the middle. That's at least what I'm trying to do. I'm sure that you were paying attention to gold and silver last week, so I did obviously acknowledge the recent sell-off, but this isn't a huge surprise to see sideways on gold. We had talked about this in a couple of our sessions. Looking at this type of kind of broadening pattern, it's just volatile. But if we come back into 2270 or so, there's still some ample support around that 2270 handle. If we go lower than that, I mean, could you see gold coming back to like 2150 or 2100? I could, but yeah. Go ahead.
No, I was just gonna say, I think a lot of times people look at this kind of recent choppiness
Yep.
and be so quick to think that, oh, it's full on reversing. But
Correct.
the way you've got your chart pulled up, the daily chart zoomed out a little bit,
Yeah.
I mean, you're sitting in consolidation right here. If you do
Correct.
break, 20, let's call it 2,300 convincingly, let's say go down to 2,250, start really breaking that level, then yeah, maybe we have some short-term downside. But people have to remember that gold doesn't move straight up. It doesn't move, forever. And even in its greatest bull markets, there are phases of consolidation for, in this case, even a few months. I think sometimes people forget that the whole world isn't day traders. A lot of times there's like swing traders, there's investors, there's stuff that takes time. Like the elections are kind of another pending event for the VIX and gold. I feel like the theme of this year. So
Yeah.
I think just give it some time. I personally am still bullish unless we break support, and then I think you have downside for a deeper pullback. In all honesty,
Sure. And I'm drawing this out here. I mean, starting from this low back in 2023, is that the low? Is it 20? This has to be 2023. Yeah. So this is September, October 2023. If I'm right in this, I mean, if this is a wave, wave 4, which is essentially a pause. Wave 4 usually is sideways. Usually it's consolidation. So I think a tricky wave 4 would be that broadening pattern. I think that a wave 5, if and when it happens, could be like another fairly aggressive run to all-time highs. I don't think that gold gets all the love that it possibly deserves technically until the dollar really makes up its mind. I look at this. I mean, I have been quite perplexed for the last couple of months on what true direction the dollar wants to go, because it's tough to trade, man. I mean, if you look at every pair individually, ECB cuts rates, the BOC cut rates, what other central banks might be cutting rates ahead of the Fed if and when they cut rates in September or November or December, or who cares at this point. We're not going to find out until maybe they give us some more information on Wednesday. And I think if the markets are all-time highs, this is also another issue for the Fed. If they cut rates at all-time highs and we have a bit of an asset bubble, that's not a good thing either.
Right.
And I mentioned this in my earlier session. There is a way that this market, just for the week or so, and this is what I'd expect. I mean, I'm staring at the technicals here on the higher time frames, the weekly charts, overbought with divergence. I could see a pullback and a correction happening. But from that pullback, as long as we don't do any major structural damage here, if we have a pullback, but then the market rips back up again, and then we just have like this. Maybe it's volatile, Nick, but if this market finds a way to shrug off and it keeps making these higher lows, we could do this all summer long. And maybe the market's only up like 1% for June, or a fraction 1%, or up a half to 1% in July. That'd still be historically accurate because it's still up.
Sure.
But longer term, we get into the election, and that's where all the drama is going to be. And I could see this. I could see us getting into the election. I talked about this earlier. I could see us getting the election. This is what happens prior to the election. The election, expect all the volatility in the world or all the uncertainty in the world. I could see the market not caring about it at all. Capitulation, blow off the top, and then I'm going to expect a reset like we had in 2022. I would expect a similar type of reset in 2025. Also, the inverted yield curve thing, we've now gone over 500 days for an inverted yield curve, but the average before we go 3 months to 10-year inverted yield curve, the average is 2 years. That's when the window is. So 24 months. And so we're not to that point yet. And that would put us in that 2025 window for a reality check. You can call it a recession. Some people already feel like we're in a recession. If you're trying to buy a house right now, you probably feel like you can't. So it's like, is that a recession? I don't know. I don't know. But it could be a wild year, man.
Just to pull that up, Chris, you're just talking about the yield curve here. I just wanted to show a chart with it. So Chris, you were just mentioning, and for those of you guys who weren't quite sure what Chris meant by that, so he's pointing out that when you take the 10-year bond yield and you subtract that value against the 3-month note yield, you get this chart. And this is, of course, plotted over time. And what we see here is that inversions are basically when the 10-year is less than the 3-month, and you get these kind of periods in which the red kind of shows up. And this current one that we're in, we're in currently a inverted yield curve, and usually, in fact, actually, it is like a 100% hit rate, I think, Chris.
It does.
when it comes out of inversion officially, it usually is a signal of a recession. And you can see 2000 dot-com era, 2008 great financial crisis, 2020, again, the COVID stuff. But here's the problem. As Chris just mentioned, we are staying steadily, and we're still far away from coming out of this yield inversion. That being said, 2025, as you just mentioned, like if you do start to see this start to really change directions, and Chris, this is part of the reason why I like TLT,
For sure.
is the idea of being long, some longer duration yields. Could be an interesting play, but knowing when that's going to happen is a tough game. I think you've talked about, your way of playing TLT is longer term. Same thing with me. I've got a position in it. I'll probably maintain a position in it for some time because, again, data is data. History is history. This has never been wrong before. So why am I, and again, when I say wrong, it could take time to prove out. So I guess you could say wrong if you tried to time it already.
Correct.
But I think at some point the reversal of that will lead to probably some slowdown. And I think some things are starting to form for that, Chris. I mean, I think you're starting to see economic data prints coming in. You're seeing unemployment rate. Frank and I were out for a beer on Saturday, and we were talking about, like when unemployment rate rises, it almost always rises for a suspended period of time. It's very rare that unemployment rate starts to go up and then it just stops and goes back down. It's usually that when unemployment rate starts to rise, which it has been doing. I mean, we could take a look at some more data for fun. Here's JOLTS. Look at job openings. Job openings steadily declining. Unemployment claims overall have been rising. The unemployment rate, et cetera. My point with that is there's something stewing there. And I think it is worth being open-minded to the idea that stocks don't go up forever, that there is a potential for other rotations to come into play, maybe value stocks, maybe bonds, maybe gold, maybe other things take a turn in terms of being the prominent winner for a little bit. But we'll see. I don't know. What are your thoughts, Chris?
Well, I think that we can't have expansions forever. I'm sorry. Like, even as bullish as this market's been for the last 24 years, it hasn't come without crisis. That's what's so silly. It's like we really haven't had a healthy free market bull market. It's been a manipulated, buy our way out of a crisis, debt fueled rally that has created like more wealth disparity, more gaps, but there's still opportunity. I mean, I hope that everyone watching this understands that if you are a trader, you have access to tools, resources, low commissions, zero commissions that you've never had access to in the last 10, 15, 20 years. I mean, before this, it's like it was expensive to be a trader. It was the secret of Wall Street was make everything seem so complicated that you can never do it on your own. And now in 2024, it's like we have zero commission. We have fractional shares. We have options. We have futures. We have Forex. We have all these instruments, which cost us next to nothing to trade with data, EDGEFINDER, tools with our brokers at our fingertips.
Right.
That, I mean, I just watched a video this week on using ChatGPT 4.0 to go through and find like trend analysis on earnings reports or trend analysis on growth and quarterly growth and earnings and going through FOMC minutes and going through all the stuff that it's like you'd have to be a professional research analyst to go through that boring material. But it's like, I mean, you want to put the proper prompts in and have the conversation with ChatGPT, but you can actually find some high quality, professional Wall Street research analysis grade stuff in your fingertips with ChatGPT. So crazy stuff, man. And so I'd look at it this way. You can either, I mean, it's E-Trade's old slogan, right? Like, get mad or get even. It's like, just trade and you learn how to trade, you learn how to survive. I mean, look, for the next couple of weeks, I wanted to tell you, like, this is my plan. So I came into the market, after a week out, and the first thing I thought of was, okay, I do expect some volatility for the next couple of weeks. Now, I look back at the SPY here, and I was actually surprised, Nick, to see that we've still gone on a week-to-week basis. We've still stretched like $11 or $12 per candle on the weekly time frame. So there's still some direction happening here. So going into this week at 533, I don't think I can time it to say that this Friday the market's going to move, $10 one way or the other. I honestly don't feel comfortable with that. But I
Sure.
do feel comfortable with the end of the month with a quarterly expiration and this kind of being I think the CPI and FOMC combo on Wednesday is a chance for the market to do something. It's going to either blow the top off or it's going to correct, right?
Yeah. Yep.
It's easy to say like it'll do one thing or the other. I doubt it's going to go nowhere. And so even if we have the same conversation at the end of the month, Nick, and the SPY's right here, I can promise you that it's not going to be this way for the next 3 weeks. It's either going up a little bit or it's going down a little bit or it's going up a lot or down a lot, but somewhere wherever we settle, that's enough for me to make some money in an options play. So that's the
Sure.
first thing I did was I did it on the SPY and I'm neutral right here. I'm going up, I'm going down. I have an $8.59 debit. Do you believe that the SPY is capable over a 3-week window to go at least $8.50 of direction?
Totally.
Right. That's my trade. So if it goes $10 one direction, I can make money. If it goes $10 the other direction, I can make money. Same thing on the Qs. The Qs, the plan is to go around, $12 or $13 a week. I got the debit for less than 10, so it's $9.95. Can the Qs go $10 for a 3-week window? Yep. They can go $15 or $20. And that's, I need a $9.95 debit to turn into $11, $12, $13 credit. I make money. Not that hard.
Yep.
So that's my plan.
I like it.
One other thing, can I ask you this?
Yeah.
NVIDIA, we just had a split. Are you doing anything with it?
I'm not doing anything with it. I am using it as a barometer, though. I'm watching NVIDIA like as much as I'm watching as any other chart right now because although I'm not trading it, it's just such a the whole market is built on this stock. I mean, it being down 1.9% today is, it's nothing. When you look at the weekly chart, it's done just, massive returns, but I'm using it as a barometer. I'm using it as I think that, if you want to be a buyer of this market, you probably want to see NVIDIA make a 20% pullback or something like that, which sounds crazy, but this thing is so volatile.
That's what I want. That's exactly what I want.
Yeah.
So I here's what I'm doing. I just looked at the chart again, weekly time frame. If this is, we've had a good run. We're at the halfway point for the year. There could be a pause. There could be sideways NVIDIA. What I don't want to do is I don't want to put a strangle on NVIDIA. I don't want to put an iron condor on NVIDIA. I think that the dumbest thing would be to try to time an NVIDIA short outside of a very out of the money dirt cheap put that would somehow get you a return if and when we had a correction. But even
Chris, I would short
everyone's been dead wrong, dude. Everyone has been dead wrong.
Willing to I don't know if I would short NVIDIA, but the only place on this chart where I'd say maybe would be a break of this. Because look at this. I don't know. I just drew this up while we were talking.
Yeah.
Fibonacci from this swing low down here where markets rocketed back, tech came flying back in April and or in May, but following April. The fibs here. We talked about this one time recently about when we were talking about dollar yen. Like this chart creates some pretty setups, and or the technicals can create some really beautiful setups. I mean, look at this. You got low to high, the 61.8% retracement was that barrier. If you are a bear on this market, in my opinion, if there's a signal to wait for confirmation, it would be that. That's just my thought. If you're a bull, you want to see this thing hold or even get down there before, for me, really get, fully exposed long. That'd be my take.
Yeah. Well, I look at it this way. I mean, if I'm correct with a little five wave plan, then this would be this top right here. If we obviously put in like a weekly high, I would expect to see some type of 1, 2, 3 wave correction to the downside. So you're talking about breaking this level and pushing lower, which would make sense because we could end up testing a lot of times in just kind of the perfect 5-wave structure. The market likes to test the bottom of wave 4. So if we have this previous resistance, obviously that could be, a very aggressive buy the dip, but that's still like a double-digit correction. If we go, let's say we retest this previous high from current price, that's still a 18.4% correction from current price. That should be over 20% correction off the all-time highs, which I know everything was split now, but we're looking at about a 22% correction from the all-time highs, 18 and change. So here's what I did. I am willing to put about a 3.5% position in NVIDIA for my portfolio, but I'm doing it with options. And so what I positioned for was a very
Long or
wide
short?
credit spread. I did a bull put spread. So I sold a 95 put and I bought an 80. So I'm $15 wide on a credit
Okay.
spread, which means that yes, I have risk on the trade, but my risk is defined and it ties up way less buying power. So instead of me saying I'm just going to put a cash secured put and tie up $9,000 or $10,000 to buy Nvidia, what I'm doing is I'll own it at 95. I'm collecting 55 cents on that wide credit spread, so I actually have a break even of 94.50, give or take. What I looked at was if I went 30 days out for a covered call. This is a wheel strategy. This is a defined risk wheel strategy.
Okay.
Call it what you want, but so that way
Yep.
instead of tying up 10 grand, I tie up about $1,400. So it's
Okay.
way more cost effective, and I'm 100% still willing to own the shares. So what I did was, here's my trade right here. If I go to NVIDIA,
You must have done this today, Chris, right?
I did it this morning. First
I
thing
was
this
gonna say,
morning.
'cause the
I did the
split
SPY, the
happened,
Qs.
so
Yep. So today was the first day of, and I was ready for this. Like I knew the split was
yeah,
coming for this week's trading, and I'm not just like sweet. It's now on sale. It's like no, the split doesn't mean
sure,
anything, right? So price
right.
doesn't have to
Market
fall.
cap
Price
hasn't changed.
it hasn't changed anything. It's still $2.97 trillion, and it's still sandwiched between Apple and Microsoft.
Yep.
But I went out to the July 26 expiration. Let me go to this account here. So I went out to July 26, and I'm running through like a 46-day cycle here, and I collected 54 cents credit. Now, the way this trade would work would be I have a sell put at $95 and a buy put at $80. So that's a $15 max risk, and I'm collecting 55 cents credit. Now, that's a terrible reward to risk ratio, but the reason I'm doing that is I'm willing to own Nvidia, right? So my break even, so if price falls, let me change this back. So if price falls to less than 95, I can take ownership by July 26. And my break even price is 94.45. Now from there, if all I did was I own the shares now with a break even of 94.45 and I sell a 30 to 45 day at the money covered call, I can get $5 to $6 credit on that cycle. So I can take a $94 ownership, lower it to down below $90, very confident that I could repair the trade, very confident that I could essentially flip the stock for maybe, $3, $4, $5 of profit. Now, I did it with I'm about to get CVS called away for like $5 a share. I had Chewy called away for like $7 a share. If I really wanted to keep that 3.5% exposure with ownership, do you think that Nvidia in the next 6 to 12 months can reach all-time highs if the broader market hits all-time highs again and again and again? So if I own the shares at 94 and it goes back to 120, why would I not hang on to it? It's like, in a way, I'm going to try to balance. Do I cover it aggressively to repair it, or do I just stay out of the way and let the thing return to the highs again and then take profit at $30 a share? Which obviously I'd be happy with that too.
Yeah, I like it. I think
that's the plan.
It'll be interesting to watch.
Yeah,
I'd be interested. Probably, Nvidia is a company that I would like to have some ownership of. I might do SMH instead. I did sell calls or sell puts for a while on SMH. I never got assigned. Go figure, because the thing just has gone straight up. I would have loved. I got I did get. I got assigned once, and then I sold calls and got called away, which obviously ended up kind of capping my upside and didn't work out in that scenario, but collected a lot of premium on SMH. Of course, SMH is like the ETF for
all
semiconductor companies. Yeah. So sold puts on that, got filled, and I've made some good money on SMH overall. I'd probably personally play that just because I like other companies like Qualcomm and Broadcom and Nvidia, AMD. I liked a lot of them, but I'd like to continue, like I said, to use Nvidia, the leader, as my kind of barometer. So I really like that pullback. If it sets up, then great. If it doesn't, I'll continue to play the sidelines. But we'll just have to see. Again, I'm currently, Chris, I'm long gold. I have a small short on oil, which I entered at a pretty decent time. But as you mentioned earlier,
Nice.
it's coming back, here today. If we break through these levels, I'm going to go ahead and just take profits on that because that could be kind of forming a break higher. But I am
Right.
short currently. We'll see where that goes. TLT, I'm still sitting in this trade. It hasn't really done anything in the last few months, but I've collected some dividends at this point, which is not bad. So I'm sitting, waiting, getting paid dividends, and if it pops a lot, I'll probably sell covered calls against it. But for now, just kind of sitting and waiting with that position. And just checking on other things too. Bitcoin near the all-time highs. We'll see where that goes. Ethereum backing off just a little bit. The euro's down on the day. Pound down. The dollar is looking strong today. So we will have to keep an eye on how this candle closes. I mentioned earlier that if that candle closes real strong today, should be interesting to see what happens with the dollar the rest of this week, going into CPI and FOMC. Chris, I'm going to leave you to take over the show here for a little bit. Frank should be joining you in just a little bit, and
Okay.
you guys can talk through some more stuff. And before I step out, guys, I just want to say to everybody who's listening, if you guys would like to hear more from Chris, he's got his own YouTube channel as well as Twitter at Real Chris Pulver. If you'd like to find him there, we'll drop the link here to his YouTube channel in the chat if you're with us here on YouTube. And Chris, enjoy the show. Take over for a little bit, and we'll see you tomorrow.
Thanks, Nick. Nice to be
All
back,
right,
man.
See ya.
See ya. So I'm just taking a look at currency strength for right now. Let me see if we've flipped the screen over. I've got the euro. So I believe we had some elections in Europe going on. I was just over there and I saw signs everywhere, but I didn't realize it was happening over the weekend. So an interesting little move right out of the gates to see, a rate cut, weaker euro, seeing the Swiss follow suit a little bit. The dollar's still kind of mixed. The Aussie strong in the day. As Nick had mentioned, a couple things with the dollar. The DXY has been a chart that has perplexed me a little bit. Directionally, I mean, this is what I'm looking for. I mean, let me help you sift through some of the noise with my chart. But basically, I looked at a broadening pattern, right? We have a high, we have a higher high, we have a higher high. I was looking to see if the dollar off of this holiday pivot, which we saw in end of December of last year, that the dollar pivoted hard off that 101 handle, and it's up. So the dollar has been stronger. Now, do we go from what looks to be a broadening pattern to something that then turns into a wedge and it gets tougher and tougher to trade? Maybe that's the case. But what I've been mentioning the last month or so is more and more of these central banks were showing signs of monetary policy divergence, which means the ECB just cut rates. The Bank of Canada just cut rates. The Swiss National Bank cut rates. The BOJ just shifted from negative policy to 0% or 0.1%, and they're going to stay that way for probably a while. In addition to CPI and PPI and the Fed this week, the BOJ, the Bank of Japan, has a rate decision and economic summary projection on Thursday. So that's Thursday night, Asia time into Friday's trading. It is always important to know that a big critical FOMC with a piggybacking Bank of Japan the same week can usually lead to some pretty wild volatility. So I'm just throwing it out there for anybody that's trading yen pairs or trading dollar crosses or Forex in general. We could have some interesting developments in the Forex world this week. So like I said, I see a broadening pattern, and this is what I was kind of eyeing all week is, this hard pivot off of, like, you can see my line around 103.85. The dollar has stayed pretty well supported at 103.85. Now, let's think fundamentally for a second. Fundamentally, the dollar could be stronger, possibly should be stronger, because it's the central bank that's now delaying the monetary policy cuts, right? ECB cut, making the dollar more attractive than the euro for right now. The Bank of Canada cuts. Oil has had a little breakout to the downside recently and then is pulling back, but dollar CAD's been up. Dollar itself has been pretty resilient, pretty strong. It hasn't been an easy chart to read. It's been a pretty sloppy uptrend, really. But if we have some drama in the stock market this week where the Fed talks things down, the dollar index is usually that pretty positive, or it's an inversely related instrument. So if the stock market is down, usually the dollar shows strength. So again, that might happen this week where the dollar gains some traction. Now, I look at the dollar let's say timeline wise, the dollar to me, I'm looking to short the dollar if we get to this point around 108 to 110, interested in shorting the dollar. If the dollar surprises us to the upside, way up here, way more interested in shorting the dollar at 114, 115 as well. So right now I remain pretty neutral, where I have some longs against the dollar, I have some longs with the dollar, and I'm seeing how those hedges kind of play out. I'm trying to manage my winners more so than my losers and try to take some net profit overall. But as it stands, I am I was, let's see, short pound dollar, and let's see here, long New Zealand dollar, long dollar Swiss, long dollar CAD, and I haven't taken a trade on the euro dollar. So a couple of mixes where it's 2 against, 2 for the dollar, and I'm still kind of letting them all just marinate in the markets, and positions are open. But as I see the chart right here, I mean, I would like to see if the dollar can get stronger through the summer, until we start to see that the rate cut cycle is maybe a little bit more of a reality. Maybe that's September, maybe that's November, maybe that's December, maybe it's 2025. That's what's so dumb about this situation. The markets are typically forward thinking, but in the Forex market, there's buy the rumor, sell the news. And if the market catches wind of the Fed actually, kind of showing its hand of when they want to cut rates instead of this like 50-50 probability, then we might see that really react in the dollar. So here's how I'm going to trade the dollar. It's not just Forex crosses. Frank, I see you there. Just let me finish my final thoughts here. I'm looking at the dollar on this instrument. This is a way to trade the dollar with an ETF. And so what I look for is the UUP and possibly the FXY. The FXY is a JPY related instrument, and the UUP is a dollar related instrument. So if the UUP were to come up to this level or this level, then I'm probably looking for an opportunity to short the dollar. But until then, this isn't an uptrend. We have decent support. We're right back in the middle of all this where things get really noisy, which makes sense why it's been confusing for me this year. But if we come back into here's support, here's a high, here's a high. If this trend line does not get broken, then the dollar to me is still going to drift higher, drift higher, drift higher. And against a backdrop of a higher stock market, the dollar can still get stronger. It's not a typical correlation, but it can certainly happen because the dollar is more attractive than other currency pairs right now. Stock market's melting up because of 5 stocks, essentially. It's your Fab 4, your NVIDIAs, your semiconductors, your whatever. All these things can just continue to go until they don't. So I'm looking at, if I'm going to short the dollar, it's going to be on confirmation or at resistance. And I probably look at 2025 as a year that I could start getting long the yen futures, micro futures. The FXY is a good way to trade it with options. So that's more currency related stuff, but good stuff. So Frank, my man, what's up, dude? Happy Monday.
Hey, man. How was Europe?
Europe was great, dude. I spent the whole week in Germany. It was like 10 to 12 hour days every day. Stayed in some charming little cities, drove all over the countryside, saw, Black Forest, Bavaria, all over the place. And actually my nephew was over there for a study abroad in Berlin. And so he came to meet us in Munich for a day. And so we did a little castle tour with him, and took him to Hofbrauhaus, and he got to enjoy some pretzels and some fine lager. So it's fun.
I was gonna say, if you go to Munich, you got to hit Hofbrauhaus.
Yep, it was fun, dude. That place, it's crazy that it's 3 stories. That's what's crazy. That place is
I know, all the same thing.
Yep, but it was fun.
Did you get a pork knuckle while you were there?
I didn't get a pork knuckle, no, but I did some schnitzel, some spätzle. I did some apple strudel. I did the Black Forest cake. Lots of pretzels all over the place. So, and
Gotcha.
a few beers along the way. But it's great, man. It was so nice. It was beautiful, and everybody was great. It was super friendly. Yep, lots of palms,
Nice.
lots of fry sauce.
Yeah.
So anyway, of course. So, dude, I didn't feel like I missed a lot last week. But this week there's certainly a lot to hold on to. So what are you liking? What are you looking at this week?
First, I just want to talk about inflation, because that's coming on before FOMC.
Yep.
And here's what I think needs to happen is that obviously this isn't going to happen, because so far, whenever we see economic news, one of them is going to be different than the other, as in like one of them's going to be better, one of them's going to be worse. It's probably going to be some mixed data, and we're not going to know how to interpret it. But what we would want to see for gold and dollar, I guess, just from this base case, is we want to see a lower inflation rate on all fronts to see a weaker dollar, because that interest rate cut is expected to come at some point this year. September is still like 50%.
Yep.
If it comes in lower, probably going to be very confident on that September rate cut. Whether or not it comes, the confidence will probably get higher, and then the stock market, gold probably going to move higher. However, if CPI comes in sticky, or if it comes in hotter, that's going to be bad for stocks. Gold is probably going to be in the same boat as stocks. Dollar is going to be better, better off, as an optimistic, and that lack of confidence will probably get pushed back till later in the year, or maybe next year. And yeah, that's kind of my thought around the dollar, at least, because if we see we're not going to see hikes, we'll probably just see very delayed rate cuts. So it may just remain here for the rest of the year if inflation just keeps remaining sticky.
I agree. And so do you have a number in mind? I mean, what's sticky? Is sticky 3.4 where it comes in as expected, or is sticky a higher print?
I think if we're not seeing any progress under 3 by the end of the summer, that's sticky.
I agree. Yeah, so let me go to, oh fudge, where's the, I was looking to see, I just want, they changed this website on me. Yeah, I want to see just the, not the aggregate. I was looking to see what the actual like trueflation, it's a third party measure, but I want to see where we're at, or actually what's easier. Let me just use this. Let's go to the factory and let's go 3.4 and go to the graph. This is pretty easy. So I think this probably illustrates pretty well what you're talking about here, Frank. Like sticky would be, there's not a lot of progress happening since we had, a 2, what is this one? 2.8, 2.9 print. And then it's been between 2.8, I'm trying to think what this one is here. That was around 2.7, but we haven't gone, higher than 3.45. We haven't gone lower than 2.9, 2.8. I think it's 2.9 is the lowest. Yeah. So sticky is just like you said, it just won't budge, right? So we're pretty much like sticky at 3%. The Fed keeps talking about 2%, and the longer this goes on, the stickier this seems, the tougher it is for the Fed to truly, say like we're going to achieve 2%. I mean, to get to 2%, we actually need deflationary pressures to see 2%.
Right.
I think the initial thoughts on deflation would have been techs leading the way. There were job cuts in 2022. There's been a softening labor market. Wages continue to grow, but asset prices have come down across the board. Commodity prices have been in balance. Anyway, so I think you're right. I would be curious on the number this week. I mean, let's be real here. I mean, the market's looking for something to do, typically, as always. And so if we print, I'd say I'll just say this. If we come in at 3.4, it might be, okay, what's the Fed going to say? And the CPI data itself doesn't really have a big reaction. Plus, when you look at the time anyway, it's 8:30 a.m. So the only thing that's going to move in the morning at an 8:30 CPI announcement is going to be futures. So if you're trading futures, then yeah, you could trade short-term, index futures on that movement. Everything else is going to be pre-market before we get into the opening bell at 9:30, and then it's all eyes on the Fed at 2 o'clock and 2:30. So I think that in order to get like a big reaction, I'd probably say 0.2% higher or lower is what the market's going to be willing to jump on, good or bad. So
Right.
I don't know if you're tuning in earlier. I am positioned for a vol play on the Qs and the SPY, but I didn't do an expiration out to Friday. I'm going out further. Now, as we come into Wednesday's trading in the morning, what I might consider, and I'll look at the prices on this, but I might consider a trade Tuesday afternoon before close or Wednesday morning at opening bell, and just look for maybe a 2 to 3 DTE. So if Wednesday is a 0 DTE, Thursday, Friday be a 2 DTE. Does that make sense? And just do
Yeah.
like a quick vol play to see if the market hasn't done anything, and here's a good way to test it. So here's last week's high and low. So this is last week's high. This is last week's low. If price is doing nothing today and tomorrow ahead of the Fed, well, I think that, Wednesday, Thursday, and Friday, this gives the market time to do something, whether it's up or whether it's down. I really don't care, but I'm watching last week's high and I'm watching last week's low. So if I can time this where it's a Tuesday afternoon or Wednesday morning trade for a couple of days, this should be inexpensive. It might be like a trade that cost me $3 or $4, but if we get, an $8 or $9 move someday this week, which is capable. I mean, we've seen like last Friday, that was a crazy day, right? This Friday move was like $7 to $8 down, and then $9 to $10 up. And then Monday we kind of rebalanced that. And then last week I just noticed like Wednesday was the only really solid directional day. Wednesday was where most of the gains were put in, and then Thursday, Friday, the market really didn't do anything. So it just started off on a correction for Monday, and then the rest of the week, Tuesday, Wednesday, where things kind of got interesting.
So I'm seeing, I understand the volatility play,
Yeah.
but I just have so many like concerns now about, upside in the market, and the fact that, we're just under all-time highs, but we were there last week.
Yep.
And it makes me wonder how much further can it go? And as we see, Bank of America and I think Citigroup talking about a record number of people just leaving the stock market, and I'm looking at COT every week, and the open interest is dying, and people are getting out of like both sides of the contracts. Like the money is just not there right now, and I keep seeing it diminishing over time. So I'm wondering how much further can we go to the upside from here now that we're at all-time highs. And personally, I am betting on volatility too, but I'm definitely more biased. I had some SPY puts that I took Friday. I closed out this morning that expire this Friday, but I still have puts on SVIX. I
Okay.
still have some small puts on some small out of the money puts on SPY for the week after, just because if we get that if that inflation data does come in hotter, or if it just doesn't really move, and then we get the FOMC saying, like Powell says, yeah, we're still comfortable keeping them here for as long as we need, as in interest rates.
Yep.
That's going to be probably a huge volatility mover. Now that earnings is out of the way, Nvidia's done its stock split.
Yep.
We have nothing but inflation now. We saw an uptick in unemployment to 4%, which an alarming statistic is that women and minorities have more trouble finding work once you hit that 4% threshold. So see a trend higher in that next month if that continues up. There's so many concerns in the market right now in the economy that even if we see good solid numbers, how far up can it go?
Well, you really started off by giving a good reason for the market to keep going up. It's called irrational exuberance. Right? It's what bubbles are created with, right? It's like if people are leaving the market, if participants are leaving the market, if money on the sidelines is staying on the sidelines, that is the perfect environment, like we saw in Q4 last year. It was like nobody participated in that rally that carried us from Q4 last year to Q1 this year, and then everyone started participating when we're at all-time highs again. So if people are leaving in droves, I mean, all that leaves us to watch is low volume drift, and the market's positive drift. So what the market would need to see would be a reasonable catalyst to react to. And so just if the Fed says we're going to stay higher for longer doesn't necessarily mean that the market's going to have this adverse reaction that's going to be testing lows and breaking structure. I could see the market absolutely correcting based on the technicals. But do I see the market getting us in? I mean, I guess this would be my concern. Either and we've talked about this too, like if this is a broadening pattern, that's a scary situation because a broadening pattern could easily look like, oh my gosh, we might have just put in a head and shoulders pattern, right? And so there's going to be bear cases where it's like, based on the technicals, you short the high. And I could see a bear correction playing out with this type of run. And we have I mean, think about it. You have a run up, you have a topping pattern, and you have a correction, and then that's your chance to buy the dip. But does that happen? I don't know. Or is it a, run up and we get a broadening pattern like this, and a broadening pattern usually goes even higher. And that's what's crazy. It's like, it could go higher because nobody is participating. And what we don't have right now is we don't have a bunch of aggressive sellers. I think that's the reality, is like the bears. I think bears are just like picking their battles. I mean, if bears want to get lucky this week and make a few bucks on FOMC, great. If bears want to get lucky trading futures because the market ticks down for a couple of days, great. But dude, the market keeps getting lifted up so far by 4 to 5 stocks, and it's not changing. So I mean, the Russell, the S&P, the S&P 500 versus the Russell, or the large cap versus small cap, it's at the biggest disparity from it's like 2001, the last time that large cap has outperformed small cap to this degree. But does that mean that small cap is going to outperform? I don't know. I mean, I think it's a potential catch-up trade, but for the Russell to come off these crazy lows and stay out of this range, or kind of break this range higher, I mean, the Russell's going to need a little relief, and that relief is going to have to come with rate cuts. So I don't know, man. I mean, I'm just look. To me, it sounded like you're painting a bit more of like this dark cloud, like ominous picture, like you just. But I guess to my question to you is, how bad do you think it actually gets? I could see a correction because it makes sense technically. We've got all these things to worry about, but in an election year, with some of the strongest margins we've seen, some of the strongest earnings we've seen, with arguably 5 to 10 of the strongest companies we've ever seen, it's enough in a high concentrated market cap especially, to keep drifting higher and keep melting up higher. And it might feel like crap. It might feel like crap where it's like, it doesn't make any sense. But that's exactly what the market does. It doesn't have to make sense. It's not supposed to make sense, And so when traders want to do rational things in an irrational market, you lose usually. So that's why I'm trading both sides. And so even when I'm trading vol this week, I'm not trading to Friday. I'm trading out to the end of the month, because the end of the month is also a quarterly expiration. And so I don't know if you caught the numbers, but my SPY trade only cost me like $8.50, and the average SPY week is $12. The Qs only cost me $9.95. The average Qs are $13. So that's in a 1 week window. I'm giving myself 3 weeks. I think there's plenty of time for me to see a $10, $11, $12, $13 move to make some profit. That's all I have to do.
That sounds like a good trade, honestly.
Yeah.
But yeah, I think all I was saying was, if you get that slow drift up for 3 weeks, I think that seems reasonable. But if we're talking about this week, like, I'm just wondering how much further did it want to go? And you're right, like with no participation, it's just going to keep drifting higher. But if we see what if we see what I guess we kind of want to see, so we can finally have cheaper prices and just better deals on different stocks, then I'm thinking, well, I guess I thought this a few months ago too, but I was thinking we'd pull back to our levels at the beginning of the year, which at the time was like a 10% pullback.
Mm-hmm.
Now I guess it would be let me see, where's January?
January is going to be right at this. What instrument are you looking at? You're looking at SPX? Yeah.
It's the S&P, yeah.
Okay.
I'm guessing like it's still like 10%, 11% pullback from the highs, but that's kind of how, I guess that's how bad I would want it to be. I'd want there to be some decent pullbacks there, so we have some relief, because right now it just feels like a bunch of pent up I don't know, like something's gonna crack at some point. And
I agree. And look, the crack can do one of two things, right? The crack can be a capitulation higher, where everyone's even more surprised, like, how is this even happening? And then that's like the reality bubble, like the bubble burst with capitulation. But it does seem, it seems like the melt up, the melt up, the melt up. It just seems like all it needs is one reason to have. I mean, and look, we had it. If you look at how price reacted in April, dude, I remember April having 3 days over a 3-week period where we had like 8 to 10 to $12 sell-off days. Those are ridiculous days, right? The average move should be like $4 to $5 in the SPY, or 40 to 50 points in the S&P, and the instrument drops 1,000 points, like or drops like 400 or 500 points, or I mean, yeah, it was like over like 11, or SPX moved like 130 points in a single day versus like 30 or 40. The SPY, instead of moving, $3 to $4, it moves 8 to 9. Those are heavy days, and so that's what you could be looking at is if this happens. And let's go back. Let's rewind to April for a second. So you just said, earnings is done, Nvidia is done, the split's done. It's true. All that is done, right? Now we're back to inflation, but does the market care that much about it? I think the market can, because if the market's going to pivot on the Fed, great. But that's what April was. April was finally, this was all inflation talk and the Fed being firm on higher for longer. If they reiterate the same thing for this rate decision and this meeting in June, then sure, I could see one aggressive candle that all of a sudden gives us the momentum to take us a little bit lower. And you're going to see what you want. You're going to see that, I think a 2 to 3% correction is this like very healthy, but also very aggressive bull market. A 5 to 7 to 8 to 10% correction, it makes people freak out a little bit, because it's hard to justify like, an 8% correction happening in a couple of days. You're like, I'm going to buy that dip, because you never know if that's going to be nastier. I mean, at any given point, these markets could easily have double-digit corrections. And one thing that I will certainly acknowledge for the last 5 years of trading has been these cycles. I mean, trading 20 years, I've seen what I think is more like highs and lows and cycles and faster rotations in the last 3 to 5 years of trading. So things happen faster than they used to. I was used to rotating out of positions and, going from value to growth or tech to whatever, like 6 months out, 9 months out, 12 months out. Now it's more like every 30 to 45 days. I'm very active with how I want to position and kind of be diversified. So I think that's one thing that's challenging, is it just seems like the market has a very short attention span. And so a reaction like you're talking about could absolutely happen. And technically I still want it. I still want to see a dip. I want to see something, but I will say for the bulls to maintain a healthy look to the market, I would say that a correction here, as long as we don't do any damage below this, that was our April low. If we don't do any damage to that April low, then I think the market can, continue on with some type of channel look where it's like, okay, we had a crazy capitulation type run. Now the market is still just maintaining bullish posture. It's maintaining trends, and that, maybe survives the year. But as we go into, as Nick and I talked about earlier in the session, if the yield curve gets out of that 3-month 10-year inversion, or the 3-month and 10-year, yeah, I think it said that 3-month 10-year inversion. If the market gets out of that, I would expect that kind of reality of a recession to be there. Whether we're sitting at all-time highs or the market's deleveraging at some point, I mean, I think the signs will be there to expect some type of like nasty move. And when I say nasty, like 2022 wasn't fun, and I could see that happening again to maybe a bigger degree.
Are you saying that the yield curve is inverted right now? So you're saying when that, what is it, the 3-month versus the 10-year?
Correct. Yep.
So when that 3-month is falling at a rate faster than the 10-year, the yield curve will no longer be inverted. And that's when you're saying is when the correction will happen, or some sort of recessionary environment in the stock market, I guess.
Yeah. So let me see. I don't know where the let me see. Let me find it on EDGEFINDER. I know that Nick pulled it up. Let me see if I can find the yield curve. So because what I was looking for is I've seen a lot of these charts where it shows like all the inversions, and then in the background there's like this shaded window of like recession, and how long they lasted. I don't have a chart like that handy, but if I look at EDGEFINDER here, let me go into interest rate data. We'll go yield curve, right? So here's our 10-year bond yield with a 3-month, and this is what we pulled up earlier on the show. So once this loads, I mean, within a ballpark, you can see that. Hang on a sec. There we go. So right here, so this yield curve, let me try to find a cursor on this. So we went. I'm more interested in when we come out of it. So think about 2000 to 2001. So as we got into it, 2000 2001. Let's find the timing. Like when exactly did the market kind of crap the bed in 2000? If we go back to the SPX, go back to 2000 2001. Same thing in 2007 2008. Same thing in 2020. Same thing in 2022. So here's 15. Let's go back a little bit. So here's 2000. Okay. So in 2000, we maintained a steady stock market through September, started to decline in Q4, which is a rarity because usually Q4 is pretty bullish. But Q4 of 2000, this market tanked and stayed bearish until September 02. So if you go back to the yield curve, this comes out in 2001, and let's see this. It just shows 2001. So this is right at the turn of the year, and let's just see what 2001 looks like. So we had Q4 pressure, and then Q1 of 2001 higher, lower high, lower low, again lower high, lower low, and again lower high, lower low. So Q4 kind of set it up, right? The market was deleveraging prior to the inverted yield curve coming out. Does that make sense?
So you're using, I saw that you're using the 2000 bubble as an example. Was that just because it's
either one? It's like you can use this, and I want to do all of these. I want to look at all these.
I was gonna say too. Well, first question I guess was, would you kind of compare this AI boom to sort of, I guess, what happened back then in 2000 when they had the dot-com phase where, every AI company now has extraordinary demand, whereas back then every random website name that went public just got bought up.
Yeah, I don't know if it's to the same degree because what you're dealing with right now is you're dealing with semiconductors, right? It's like you have Taiwan Semiconductors, you have NVIDIA, you have Micron, you have SMCI, that's a super microcomputer. You have ASM, right? You have like 4 or 5 like major instruments that are most of the weighting in the SMH semiconductor space, but it feels similar. Like it's not the same thing. Like I don't think this is stupid, impractical money that's going into a space that is kind of revolutionizing tech and being like this next big like Web 3.0 type movement. But it certainly feels like there's way too much hype going into these ridiculous valuations where fundamentally these stocks don't make any sense to be the price that they are. Like NVIDIA, growing to be the second largest company in the world at sales that are less than the any one company in the energy sector, right? It's like it has a market cap that's bigger than the entire energy sector, but it has sales pretty much less than like all of them, but the margin is ridiculous, and I just think that the market loves NVIDIA right now, and that's great. But as I mentioned this earlier in my other session, this is an interesting point I read this weekend. There's a difference between a competitive advantage and a moat. Like Warren Buffett and Charlie Munger's thing is like find companies with a moat, like a Coca-Cola or a PepsiCo or a Apple or a Google or a Microsoft. Like these companies that we've known that have been like these storied Mag 7 storied stocks for 10 years, 20 years, they've all come from buying up all their competitors and being the companies that they are today. And they do it with steady growth. They do it with a lot of cash on hand, and they don't have to be first to anything now, right? Like Apple doesn't have to be first to make chips. But what Apple can do is they can do what they're doing today at their conferences. They can roll out this big grandiose plan and say that we're going to get into the AI space and we're going to do this with our chips and we're going to do this to innovate and revolutionize what we've been doing, blah, 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 blah. And they can be great at it. And they can do it probably better than everyone else, but they don't have to be first because they've already established this moat that they're safe, right? But NVIDIA just has this crazy head start where the stock does no wrong. It's growing at this blistering pace, but that's what makes it scary, because I don't see NVIDIA sustaining the type of rally that it's had outside of having some, 10, 20, 30% pullbacks and having some volatility here and there. But then maybe the space is the next 1 to 2 years before NVIDIA's reality check really sinks in. Maybe a downturn in the overall market, now that NVIDIA is, the second largest market cap company. If the whole market turns down and NVIDIA goes with it, guess what? That's going to drag the Qs way lower. That's going to drag the S&P way lower. So it does feel like a brink. Like we could have some nasty stuff because so few stocks are driving the market higher. And I would say if I looked at Apple versus Microsoft versus Google versus Amazon, and you throw NVIDIA there as the second largest company in the world, NVIDIA's power to pull the market down on a correction is a little bit more concerning than like Apple. Apple was down 15%. I bought the dip and it's back up to all-time highs. Right? NVIDIA, if it's down 15, 20%, dude, it might drop 50% before it goes back up. I don't know. So that's what's weird. That's all.
I was looking last week. There was one day, I was looking at a market heat map. Everything was red except for NVIDIA and maybe a few other stocks. Guess what the market was? Market was also up. NVIDIA was the only thing propping prices up, which is so crazy to hear, because it's like a $3 trillion market cap. So it's just the second largest, I think, company in the world. But here's something I wanted to show you too. Was I studied this a while ago. This is just here, but so June 2007, interest rates peaked, and then the consecutive months to years pass, like once you get into 08, 09, you see this continuation, this steady drop in inflation or interest rates.
Mm-hmm.
It's funny because people see higher interest rates as like a deterrent for the market, but it's in this scenario, it was lower interest rates happened almost simultaneously with the recession, which could be
and it's a reactionary.
The 3-month yield is also short term. This is a 2-year, but if we had that 3-month, crossing back below the 10 years, so the 10-year yield is higher than the 3. That is I guess a major signal of what could happen. But,
sure. One more thing here, just so let's go to 2007, 2008, just the same idea, the 3-month versus the 10 year. So this shows in 2007, we're still in. So this goes from, 2007, we bottom out here with the inversion. We start to rally, become normalized, where all of a sudden we're no longer inverted. That's 2007 into 2008. So let's just say that's Q4 of 2007 into 2008. Well, Q4, again, double top here on the market. Q4 2007, lower high, lower low, lower high, lower low. You roll into Q1 of 2008, the market's already established that we have resistance. So I guess my point to this conversation would be, one thing to look for this year would be if Q4 is a bad quarter for stocks, then 2025 looks like way worse, in my opinion. So, I mean, again, I'm going back to 2 major crises. I'm going back to the dot-com bubble and the great financial crisis. And I still think today, a downturn in the market, I hope, would not be nearly as scary as what 2007, 2008 was. I don't think people realize how close the entire global economy was to a collapse. I mean, you had the entire market, the entire housing market, you had the government, you had central banks around the world. Like it felt very similar to 2020. It's like it took everyone's effort to kind of calm the storm and stabilize what was just a free fall. It could have been way worse, right? But the scary thing is just from an index perspective, this was a 50+% correction. So Frank, if we're at all-time highs and it feels great, it's going to feel like absolute trash to be at a 50% correction from all-time highs without playing defense. So, and again, I just think that's the black swan that, I would still continue to kind of be aware of, but not necessarily. I'm not betting on that right now. I think that what I want to do is I want to play a lot of defense. I want to have diversification. I want to lower the volatility of my overall portfolio. And I just think it's interesting, like as we get out of that inverted yield curve, we typically see the timing of this, the last couple of major crises we've had. It's been a Q4 downtrend that carried over into the next year's downtrend until it became stabilized. So that's 2007, 2008. We go into the next big one, which would have been our 2015, 16 was sideways. I'd say 2018, where we had just that crazy end of the year correction. So this is a weekly chart. So 2018, 17 to 18, this would have been end of the year. So this market, I don't think this did anything on the inverted yield curve, but 2018, nope. So we went down. Yeah, it's 2020 is the next one. 2018 was just a Fed policy thing. And then 2020, we were just drifting higher until we didn't. Like that was certainly more the unexpected. But what's interesting on the 3-month 10-year is look at when this thing dipped. Here we are, 2019, we're in an inverted yield curve. And then almost immediately into 2020, we go from inverted to normalized, right? And it's, again, I'm not calling like a timing on this, but I do think it's interesting. Within about 2 to 3 quarters, once we come out of this, and I mean, again, this to me is like, this is uncharted territory. I mean, I've traded through this. I've traded through this. I've traded through this. I'm trading through this, but we don't know the answer until the dust is settled. And so whether this is, more of this, more of this, more of this, more of this, but I will say that I will be paying very close attention to when this starts to rip up, because when that happens, I mean, the type of slingshot effect that we could have with these yields going from this historically long inversion to then back to normal, I do think that there will be some type of adverse effect, or there'll be some type of risk-off consequence in the market.
Do you think the longer it stays down there, the worse off it is, or is it just?
I just think the more violent it becomes. Like if we stay down here longer, I see this just going like all in one foul move, like one big swoop. It's going to be like back to normal, back to no longer inverted, to like good luck. And so what I would expect is a lot of volatility, right? We go from, a VIX at 12 to, maybe we have a 40 to 50 VIX again. Maybe we have an 80 to 85 VIX again, like we had twice, right? COVID was an 80 some VIX, and the Great Financial Crisis 2007, 2008 was an 80 something VIX. That's unprecedented in the history of that instrument. But I could just see that the longer this stays, the more violent that actual like quote correction becomes. And having said all that, there's a lot of money that can be made on that too. That's the crazy thing. It's like I could trade the same way that I trade right now, have defined risk, have volatility plays, and pick my battles. But dude, the amount of movement, if the SPY was going to move $10 a week, but we're in a crazy bear market that's in free fall, you could have $15 to $20 to $25 weeks on a single instrument that you might be paying, $5 to $8 for. I could make, 100, 200% gains every single week on my positions if the market's just in a crazy volatility free fall. So there's opportunity that comes with it. But what the scary part is this is what we talk about every single day. This is what we do every single day. It's the vast majority of passive investors that don't want any type of decline in the market at all. I mean, if your 401k or your pension plan or your retirement plan is sitting at all-time highs and you're not playing defense, that's what would scare me. If somebody like 2022, I mean, I had clients with IRAs that if it wasn't for my active management, they would have been in 30 to 40% drawdowns. I mean, can you imagine being worth $10 million and all of a sudden you're worth 5 or 6 just because the market had a bad 6 months? That's a terrible environment, right? So I think that's what is the reality for the most people out there that don't do this every single day. If they're not trading it, or they're not having any type of active hand in their retirement accounts or their management, that's what scares me. It's like the people that just have believed in the system, have invested, and been convinced like the best thing to do is put your money in an account and let it grow and just buy the index and blah blah blah. But the index is not perfect, right? The SPY can have a 20% correction, and your all-time high. I mean, just think about if you're retiring this year. Number one, you wouldn't be exposed like this in the stock market. If I was going to retire this year, I would have my money in a 12-month CD collecting 5 to 5.5%, and I would walk away. I wouldn't do anything in the stock market. If I needed
Same.
money and I needed safety, I would be in risk-free money market instruments right now, tie up my cash, make my 5.5%, outpace or match. We say inflation is 3.4, but stuff's expensive, dude. I mean, here's a funny little story. So everything was pretty affordable in Germany, like going over for the week, adding up the travel, the rental cars, the stay in the hotels, everything was pretty reasonable. But for some reason, and I'm actually going to fight Hertz on this. So this is a shout out to Hertz in a bad way. But my nephew came into town from Berlin to Munich, and they came to see us, and we were going to spend the day with them. So I grabbed a car from the airport at the Munich airport. It was a $400 rental car when it was all said and done for less than a 24-hour rental. And I listed it for a 2-day rental at $75 a day. And somehow with the location fee and the airport fee and the minimum coverage, and this, it's like, it was a $400 bill for less than 24 hours. Like, and then we went out to dinner, we did the tours. Like, it was like $1,000 day just to have 2 kids come with us. And it was a great day, but I'm like, how did this all of a sudden happen out of nowhere? So I'm saying, like, stuff is expensive. If you're not paying attention to your budget, it gets out of hand pretty quickly. So anyway, I don't know where we're going with this other than the market's going to be risk at some point, and it's going to get nasty. And like, Frank, you're already feeling it, but I'm telling you, man, like, this market with less participants, what feels like less participants, is still the perfect breeding ground for higher highs. And they don't make any sense. They don't make any sense until all of a sudden it's like, it's going to be just a nasty, ugly
all of a sudden it
correction.
just cracks and you don't really see why. You don't really know why that reason is. But I know myself, I have a history of being way too early on things like this.
Yeah.
So
I agree.
seeing as it is
happens.
now, that was like back in 2020, I bought at the lows. I bought a lot of companies at when everything just crashed. I sold them like a month and a half later. So I missed out on everything, like McDonald's, Starbucks.
Yep.
I don't know. I had a bunch of stuff that I just let go because I was like, we're too high. We've moved up too much in such a short amount of time, only for it to bust through the highs of 2019 and continue on. But so I know I'm early. I feel like I'm early, but I'm just saying that the ground is shaky. I don't feel comfortable.
I know. I don't disagree, but I'll say this to wrap up today's session. If it feels uncomfortable, the best thing you can do is go risk defined. That's it. Like, risk defined, take your stabs, take your trades, but if they're losses, it's manageable. If they're winners, that's what you expect. But it should never be like the make or break of, oh my gosh, the market's up X amount or down X amount, and all of a sudden it completely unhinges my entire portfolio, right? Like, that's not well managed. If you're doing it the right way, it's like, the market can do all sorts of stuff, but our job is to bulletproof our portfolio. So whatever it throws at us, it's not tied to it 100%, right? Like, we try to take down the correlation where, the broad market can sell off, but what can be good? Well, maybe gold can be good. Maybe energy can be good. Maybe value utilities can be good. Maybe other stuff is still going to survive. Maybe consumer defensive can be okay, right? Doesn't have to be like I'm killing it. I mean, the only way you're going to kill it in a bear market is that you're heavily positioned for it, right? Like the Stanley Druckenmillers that have made their fortunes and their legacies on being right in a bear market, they do it because they're freaking levered like crazy. And then once in 4 years or once in 3 years or once in whatever, they get it right and they just make 10 to 1, 20 to 1, and they crush it. I mean, again, got plenty of time to fly in the air with 20 plus hours of travel. All the movies that I watched, I still threw in The Big Short. I've watched that movie probably 100 times, dude, and I still love it.
You saw that too.
I still love it, man. I still love that movie. And when it's Michael Burry's character, so Christian Bale, but Michael Burry, when he's just explaining, he's like, I can't be sarcastic, I can't be funny. And the big investor wants their money back. He's like, I'm not wrong. I'm just early. And the guy's like, it's the same thing, right? Yeah, it's like, it's true. It's like, if you're early, if you hang on to your position, you could be right. But man, that's a really slippery slope, because if you're early and this market wants to run a year or two against you, That's the scariest thing in my opinion, is like you're wrong and all of a sudden you can't afford, or your emotions can't hang in there long enough to be right. And then that's the worst feeling of your emotions got the best of you. You lost track of your big picture plan, you bail on it, and then you're right only to say that if I would have held it. But knowing how you got yourself into an emotional state, you start making bad decisions. So define the risk, tighten up the risk. And I heard this on Tasty this morning. Some of the traders, they've got 20 some people on Tasty Live. Some of their people are like, I'm in less positions now than I've been in years. So many people are like scaling back, and because they're probably in the same feeling as you are. It feels like at any time the market can break, and once it spills over, maybe it gets really ugly, and maybe it does. But the question is how exposed are you if it happens? Obviously I want to be right. If the market's going down, I want to be right. I want to be hedged. And so right now, if I've got some SPY and some Q exposure and I'm right, I can maybe make a couple $1,000. I've got a VIX exposure that can maybe an extra $2,000 to $3,000. So if I can take a $5,000 to $10,000 drawdown, but I can still make $4,000, $5,000, $6,000 in the process because of a downturn, I can essentially weather the storm, right? Where I can stomach a single digit drawdown as opposed to, oh my gosh, my entire portfolio is down 10%. It won't be that way. Like I'm hedged enough that I can probably cut a lot of that risk in half. So
Yeah.
that's all.
No, you're right. Just keep it defined and don't go too crazy. Don't overexpose yourself on either side. Just play defense.
Just trade, man. And that's the thing, like trading and define risk. I mean, everything in stocks, if the stock goes to zero, that's defined risk, right? If I put $1,000 on the line for a stock at fractional shares, it's $1,000, it goes to zero. That's my risk if I want it. NVIDIA, the trade I did this morning, I'm willing to take NVIDIA shares at like $94.50. I'm also willing to own it there and then work the cost basis down aggressively and see if I can, turn it for $10, $15, $20 a share. If NVIDIA goes to a 50% decline, well, I'll be upside down for a while, but my max risk is like 3%. So can I take a 3% exposure and draw it down and have a 3% drawdown? Sure. If NVIDIA goes to zero, my entire portfolio is down 3%. Okay. It's just like nothing is a make or break. So that's trading. All right, man. I see a lot of people asking for gold and stuff. Just come back into the session tomorrow. Nick talked about gold a lot. We talk about gold every single day. I still like buying on gold. There's certainly been some corrections. We've had a great run thus far. Gold and silver have pulled back. But the reality is I still like both. I'm long silver still. It's one of my favorite technical positions right now. I hope it's higher by the end of the year. I hope that gold is higher as well. The dollar is going to be interesting this week to keep an eye on. Keep in mind, we got a lot of news to come out this week. It's all Wednesday, Thursday, right? CPI Wednesday plus the Fed. Thursday is PPI, sorry. So we have CPI, Fed, PPI, Bank of Japan on Thursday night. So to me, all the excitement, Frank, is going to be probably Wednesday, Thursday, and then maybe the market opens its eyes again on Friday and it flinches and it's 10 points higher, 10 points lower, or whatever. So I'm looking forward to it. And honestly, I mean, you and I will talk all week, but if my $8 position on the SPY is up to $12 in credit, I'm going to take profit. Like I'm just going to trade it, and I'm out 3 weeks on those trades, man, because it was to me, I justified like I don't know if it's going to be a big move this week, but similar to having like end of the month and quarterly expirations, I think there's enough to give the market to go like something to go on with this week's volatility. So we will see.
Gotcha. Well,
cool.
Thanks for being on here today.
For sure, man. That was fun. I'm like, I know I was out. Believe me, I was ready. Like I don't know how I'm as wired as I am right now. It's like I didn't have any extra sleep. It was a lot different than the Australia trip I took over the holidays. I was like drained for a week, but this was 5-6 hours. Isn't that big of a deal? I slept enough on the flights. So I don't know. I'll crash probably. Maybe I can hold off till Friday afternoon. I'll crash.
Yeah.
So, all right, dude. Thanks for being with me today, everyone. Thanks for tuning in, and we'll see you next time. Thanks.
Yep. Thank you. See ya.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.